The point of doing this is really just to kind of bring our closest stop loss partners to the table and have you ask them anything you want about what's going on in the stop loss business or otherwise. It's really completely up to you. I've got some questions that I've prepared just to kind of set the table, but it sure would be nice if we could get some people raising their hands and asking questions and getting some answers for these guys. So with us is Steve Butts from IMG-Stop Loss. Wave your hand or something. Pete Doran from IHC Risk Solutions, Rob Frischman from Optum, Mike Hirsch from East Coast Underwriters, Chris Cooper from Montgomery Management, and Kurt Ritter from Spectrum, who was the star of our video this morning, which is awesome. But so, okay, you guys were all here last year. What's new in the stop loss business? Anyone have anything that they're seeing out there that's interesting and happening? Rob, apparently you get the microphone.
I guess I have the microphone. I don't think it's anything new, but we are seeing a fair amount of those groups that are having to offer benefits. So some of those groups that have a lot of part-time people, and all of a sudden they have to offer the benefits. We're seeing, I think, a fair amount of that these days. It can be a little challenging when you have no idea what the participation is going to be. So I'd say that's probably some of the newer things that I'm seeing.
Yeah. Anyone else have anything?
Yeah, I would say MEC plans and minimum value plans are, on the rise.
Okay. Speaking of MEC plans, and obviously we're seeing a lot of that as well, and we've implemented a lot of it for January 1. Why would you put stop loss in place on a MEC plan?
You wouldn't.
That's a really good question.
All right, you wouldn't. Anyone else have a comment? Pete, do you have a comment on that? Because I know you do it.
Yeah, we actually do quite a bit of it. You wouldn't obviously on the specific, but if you would put it on the aggregate coverage. And I would agree that the MEC benefits, the 68 preventative services, are really crap. I mean, it really doesn't provide much benefit. But what we've done as a company is we've tried to allow for our partners like Cypress to add a small RX card, maybe $2,500, and maybe a handful of doctor visits. And it's a plan that doesn't quite meet minimum value, but it does bring an additional level of benefit where if somebody gets sick, and obviously these are low-wage employees that elect these plans, but if somebody gets sick, they have the ability to go to the doctor, get an antibiotic, get back to work. And so it does create an additional level of benefit.
All right. One of the, in addition to the MEC plans and the minimum value plans, what we're seeing, and we've talked about it already a couple of times here over the last day and a half, we're seeing a lot of people talking about going from fully insured to self-funded plans. The problem that we have, and it's a problem that all of us have, I think, and Steve, you and I had this conversation at one point, is the Blues and United and Cigna and Aetna are doing their level best to not give you any information. It's really, really difficult for us to get information from those people in order to get a real, true, accurate look at what a stop-loss policy should look like. So how do we deal with that? And Steve, maybe you can kind of share some of your thoughts on what we talked about.
Well, it is the case. It's always been the case from the fully insured market, but I don't know about you fellows, but we sense an uptick or a greater degree of resistance from the fully insured marketplace today in providing reports and information, claim experience. And oftentimes what we get is irreconcilable. So we have reports where paid date ranges overlap or are not consistent from one report to the next report. So, it becomes useless to the underwriter to a great degree. So, the brokers and the employer's role in putting pressure on your incumbent carrier to provide useful information is paramount. Beyond that, the more time you have and the more influence you have over your incumbent carrier in terms of making those requests for that information, and the more time and information you can give to us, the better we can underwrite your risk, and the better idea you're going to have about what your risk is as a self-insured employer going in.
Yeah, and Mike, because you guys deal a lot with the probably small to mid-size employers, how are you dealing with that, with the lack of information?
Yeah, most of the stuff we're doing is we're rolling over cases between 25 and 100 lives from fully insured. We're helping our partners do that. And, there's the modified community rating going on, and what's happening is, the young, healthy groups are not getting the credits they once received before, and they're getting larger increases, to help subsidize for the older sick groups. So that's tough for us to actually evaluate that risk. So what we've been doing is having medical questionnaires completed. And I know there's a lot of pushback out on that, but it's been, some of our partners are doing a really good job with that. It's a good tool. It's really a good tool for the stop-loss carrier to underwrite the risk, and it's a good tool for the actual employer. They're going to know what's going on. Do you really want to enter a self-funded arrangement when you have a lot going on? And it's also a good tool, which has been talked about today, for the TPA. They're going to have information. If someone has hepatitis C on one of those forms, they could start managing it right away. So those are the pros with the medical applications.
Yep. I do have and maybe I should ask the audience, that speaking of medical apps, how much of a problem is it to, and not, maybe this is really to the brokers or the consultants out there, how much of a problem is it to get medical apps done for an employer if they're looking at this kind of thing? Is that an issue? Kenneth, you got something?
I would say that I've done it.
Sorry.
Thank you. Is it a challenge? Yes, it is a challenge. Can it be done? Yes, it can be done. I found a company that I think Drew and I, you would agree, that worked out really well. FormFire, it allowed us an opportunity to send out a link to all of the employees. Employees were able to go into that link and fill out a medical risk questionnaire that then was able to be shared with, each one of you have a different form, and each one of you have a different form that you want to be used, and so that is really probably more of the challenge. But through FormFire, we were able to use a form that had all of the information that every single stop-loss carrier and carrier would use, so that was very useful. I do have a quick question, though, while I have the mic.
Good, thank you. Here's a $100 check. No,
Thank you, absolutely. Hey, don't use it here, though.
I'll buy you a drink later.
It's going to get better, right, now that we've fed the machines, right? My question really has to do with level funded, and if any of you could kind of talk about if you continue to see that market evolve for you as stop-loss carriers, and if you're, I am specifically in California, and so we can only really look at self-funding on groups that are 50 and more, and so level funded becomes really kind of a bridge for a lot of our customers, and so where are you in that market space? What are you continuing to see maybe in that space?
Well, Montgomery, we've got about a $30 million block of business of what we call level funded or aggregate only type of business. California has been a challenge because of that 50 live minimum. But we found that overall, most of our groups in that block of business fall between 35 and 85 lives. We have some on the smaller end and some on the higher end, but I would say 80% of them fall between 35 and 85 lives.
And Kurt, you're doing a lot of that as well, right?
Yeah, we've had a level funded product for a number of years. What's interesting to me about level funded is it doesn't really mean anything anymore, because there's probably 6 very different versions of level funded just on at this table. Some level funded has a specific in it, some doesn't. So I think you have to be a little more specific when you're talking about what level funded is. Ours is an ag only style product, probably similar, but obviously much better than what Montgomery Management offers. That being said, Chris has better hair, so it evens out. But yeah, we continue to see interest. What's fascinating to me about it is when we developed ours, and we were an early adopter, the idea was that it would be a bridge product, and it would be that mechanism that would get an employer from fully insured to self-funded. And what we found is that they've stayed with the level funded product. Now, we tend to market towards smaller employers, and I think there's a comfort there with the budgeting process, and maybe that's why they're staying. But it's been a very good product for us. To digress one little bit about medical questionnaires, you only have a data problem the first year. Once you're self-funded, these guys give you all the data you can want and more. So in my estimation, the medical questionnaires are worth it to get out of the trap of fully insured and to get into self-funding. So, you know, that would be my message to you, is that even if there's a little pushback at the employer level or at whatever level, something like Foreign Fire does make it easier, but take that step, because it gets you out of the trap of fully insured, and then you have the data moving forward. So.
Yeah, and there's a number of firms, Foreign Fire is one of them, but there are a number of firms out there that are in that technology space right now, and it just makes it easier for everyone, if you're going to do this, to use one of those mechanisms, because it helps those, as you go through the forms, it won't let them move on until they finish fully answering a question.
To also address your question about the level funded product, and to Kurt's point, that means different things to different people, what level funded actually is. If the goal of level funding is having a fixed budgetable maximum liability on a monthly basis, so the employer can write one check per month, and it feels like a fully insured program from a cash flow basis. There's a number of different ways to do that with an ag-only product as well as specific and aggregate. The key is, are the stop-loss carrier and the TPA on the same page and working behind the scenes to make sure that the funding happens on an advanced reimbursement basis, both specific and aggregate, so that the funds are in the account with every check run during the month. That's basically the key to it, so that the employer can write one check per month and know that their claims are going to be fully funded.
And I'll add one thing regarding the health questionnaires, is that we actually don't require them, but we do say that if you do get them, we do want to see them, and we don't require a certain form. Whatever form we get, we'll deal with it.
There you go. Who's got questions out there? Anyone? Here's one right over here. Awesome.
Thanks.
We've heard a lot about cost containment so far, and my question would be, if you have a new group, a new employer that's looking to move into self-funding, and they're willing to be entrepreneurial and they're willing to embrace some change and implement cost containment, how do you look at that? Obviously, everybody's going to have a different viewpoint, but how do you look at that in terms of setting the rates and assessing the risk? Because my impression has been it's always, you got to wait a year before we need the proof in the pudding, which I understand from an underwriting perspective, but from a marketing perspective, it doesn't quite jibe.
And let me add to that question. Does it matter who the TPA is?
Yes, it does. And I think all of us up here, when we go through our process, we're evaluating the networks, and we're trying to do the cost containment if you're putting in a transplant writer or those kind of things, giving you credit for those things. It is very sensitive to where you're located in the country, the demographics of your group, those kind of things. But I think we all pretty much try and do the rating the best we can based on the information that you guys get to us through the TPA or the broker.
And I'll comment to that. You heard Kurt's speech in the presentation earlier today about the TPA really does make a difference. I think I speak for everybody up here, and we've had a very positive experience in working with Cypress over time. I can speak personally to IHC's loss ratios, which are a good 20 points less than that of our average national account TPA relationship, and it's for good reason, all the things that Tom talks about here today. So when my underwriter, Scott, he's in the back, he's half awake, but he's back there. When he looks at a Cypress account or is quoting a Cypress account, he has a certain amount of underwriting discretion. I'm assuming the rest of the stop-loss carriers here do as well. So he will implement that stop-loss discretionary credit, whatever you want to call it, specifically looking at a Cypress account. And more importantly, I think we respond to competition when we're working with the Cypress account reps, and we'll be more aggressive in that response, knowing that when we do implement an account with Cypress, it's probably going to outperform the market in terms of loss ratio, and that's how we look at our business.
He just made the video for next year.
Yeah, there you go. Anyone else have a comment on the specific question? Or mine, whichever. No? Nobody? I do have a question about, speaking of kind of implementing those kind of programs and what have you, and trying to get going from, whether it's going from fully insured or going from self-funded, what kind of mistakes are you seeing out there that that TPAs or brokers or employers kind of do when they're coming to you and saying, here's what I want, give me a stop loss quote? Are there consistent problems that you see that affect the underwriting process? Mike, do you have something?
Well, I think, a lot of it is, I mean, it's a very detailed process to move a fully insured group to a self-funded platform where there's different contract basis, 12-12, 12-15, 12-24. So it's important that we do a great job educating our TPAs and brokers on the contract that is actually being sold to the prospect. Because if they buy a 12-12, which is an immature contract, and they think they have a mature contract and they want to leave after year one, there may be some issues there. So it's a lot of hands-on communication and education with that process.
We see a lot of employers trying to take their past fully insured plan document and just flip it over to the self-funded plan. And I guess that is a common problem and leads to a plan that doesn't function very well. The best thing you can do is allow your third-party administrator, and this is another area where Cypress shines, is to develop a plan document for your group, as opposed to trying to take your fully insured plan and make it a self-funded plan through that existing document. There are other things that need to be added to the self-funded plan in terms of allowing Cypress to do the things they do from a cost containment standpoint that you can't do with a fully insured plan document.
Yep, that's a good one.
And I also think there's sometimes misconceptions out there that a level funded or an aggregate only is a duplication of a fully insured. Well, it is from probably a billing standpoint, but it isn't from a plan functioning standpoint, because there's no, in a fully insured rate, you have reserves and things like that. Those things are not included in the level funded or aggregate only. And sometimes that gets confused.
I'll steal this for a second. A lot of times we're not up here, we're not at those employee meetings where the brokers and consultants are at, but it seems like a fair amount of the times when I'm talking to the brokers or consultants and I hear what they're saying, and they're seeing that the aggregate, and it sounds like they're almost telling the employer group that the aggregate, this is your cost of your plan, and it's not. I'm sure basically everybody here knows that, but a fair amount of the brokers I'm talking to, they're laying it out, and they're saying that the cost of the plan is what the maximum is. It's the maximum exposure, but the aggregate factors are not the cost. They're variable costs. So I'm not sure how many times, I don't think it's communicated right exactly when you're comparing fully insured to self-funded, that yes, you have your maximum, but that's your exposure, not your cost of the actual plan.
No. Good ones. Who's got a question, anyone? I got a whole list of them, so I can keep going. There's one way in the back we go.
Yeah, sure, I'll take one. Just want to make sure that was on. So we've spoken a little bit about the transition from a fully insured platform to a self-funded group. We mentioned health risk questionnaires, kind of going down that path and doing that much legwork to get a viable stop-loss quote. We just spoke about attachment points as being demonstrated as the maximum cost of a plan and how brokers represent that in the market. We know that's not a real number, it's not a fixed cost. However, the attachment points need to be sellable. I mean, we can't look at a maximum liability of a plan at 200% manual. So let's talk a little bit about what strategies you have to maybe do a better job, or what you're looking to, not say do a better job, but maybe better the quotes from fully insured to self-funded, so that way the attachment point is palatable.
One of the things that we do is, and there's no mystery to this, we try and get the renewal rates from the carrier, and if we can possibly, we'll try and shadow price that to give the broker and the client an opportunity to get into the self-funded world.
Isn't that, didn't you mean to say reverse engineering?
Yes.
Yeah.
Reverse engineering.
And there's going to be some times where, and again, I'm not speaking for everybody, but that when you look at it, the fully insured renewal, it's sometimes that their claims are $1 million and the renewal is $1 million, where it's just not going to work. So sometimes it's not so much that the stop loss carrier is providing a quote that is unreasonable. I think sometimes our quotes are reasonable. It's just the fully insured premiums are not reasonable. But I think if you have $1 million in fully insured premium, and your maximum exposure is 1,000,001, but your expected is 800, so you're talking a 2-to-1 ratio between on the good side. I mean, that sounds like a good bet, but I realize that the HR people or whoever's making the decision, that their butt could be on the line, that if they say, okay, let's go self-funded, and then that's the bad year, and they have 1,000,001, and the owner of the company is saying, wait a second, we passed up a guaranteed million, and we just had 1,000,001. But if that mentality is not, okay, this first year may not fit, but we're not talking a one-year solution, we're talking a 5, 10, 20-year solution.
I think you're talking about manual quotes, manual aggregates. You know, all of us rely on our underwriting manual. However, the network, the proposed PPO network, plays a big role there. So, you know, it could be from a 20% discount to a 50% discount on the PPO discount. So communication is key. We're always, ECU is trying to propose alternative networks, you know, according to the zip code and location of the groups, to help, you know, bring down that aggregate. I mean, it could be a 20-25% difference on the aggregate. So that's something to consider.
And Mike Hirsch just stepped into the classic Cypress trap. Why do you worry about what the network is? Why? We've just spent the past, you know, day and a half talking about how networks don't really make that much of it. In fact, they might hurt. Why? And this is a question, and I'm not, you know, picking on, well, I am kind of picking on Mike, but it's really a question for all of you. Why is it that networks are so important in the underwriting process?
Because if you're not going to put something else in place like a reference-based pricing program or something, our goal is to get you to use the best of the worst networks. Because there has to be something there. There has to be something there to get us off of billed charges. And, you know, I've thought for years that reference-based pricing was the answer. Now we've seen the market go hot and cold on that, and luckily it's hot again. But again, there has to be something to get you off of billed charges. And so the networks are the necessary evil until reference-based pricing or no PPO stop plans are the norm.
Anyone else have a thought on that?
I have a comment on that. And, you know, discounts off, I think somebody made a comment earlier in one of the presentations. What's a 50% discount off of whatever? You know, it's not much, but there are some networks where they're per diem rates, they're set rates, and that is huge for underwriting compared to a percentage off. So some networks do differentiate themselves. Having a cap, there's no outlier provisions, basically meaning after so many days, it's going to revert to a discount off of bill charges. That's where a lot of us can get caught in the trap. So there are some networks that can definitely differentiate themselves.
Speaking of reference-based pricing, if we stick on that for a second. Last year, I think we talked about this last year, and I think to a person, everyone was kind of like, we haven't kind of figured it out yet. Have you figured it out yet? And what kind of impact that's going to have on, I mean, what kind of expectations to somebody, if they're going to implement a reference-based pricing plan, what's that going to look like from a premium and attachment point standpoint?
Well, from our standpoint, we've worked with John Powers, NAMPS, and a few of the other companies that are in this business, and they've now gotten enough business on the books that they can share that information with us. And I believe that the reference-based pricing is worth at least 15, maybe 18% more than the best discount you can get out there from a PPO.
I would echo that, and I would say it also depends on reference-based pricing, again, is one of those terms that can mean different things to different people, but it's all on how the plan document is written and how strongly the language enforces the reference that you're basing it. You're basing the reimbursement on. So to the degree that it is a set percentage of Medicare is going to get a better underwriting discount than if you leave room for negotiation above and beyond a set percentage of Medicare. So we figured it out. I think we all know how to underwrite it. It's just going to vary a bit by the program that you're actually implementing.
Yeah, Tom, by the way, Jodeci, Mary J. Blige, 1989, Philadelphia Academy of Music. Not quite New Kids on the Block, but...
And I'm thinking not too many people in this room have a clue
Nobody
what
knows
that
who Jodeci
means.
is. I'm going to do something that I probably shouldn't do, and that's disagree with John Powers. John's in the back. You heard him from AMPS yesterday. He's a very big man, so I don't want to disagree with him. But he said that this is not for everybody, but I disagree. I think that everybody in this room should take the time to educate themselves about reference-based reimbursement, because much like captives, for me, it's the biggest movement in healthcare across the country. We're a stop-loss carrier. 8 of our largest 10 claims are in-network claims with the BUCA network, Blue Cross, United, Cigna, Aetna. Our biggest claim to date is a $1.8 million claim in Las Vegas, actually. It's an in-network claim. We're getting a 12% discount, okay?
Yeah, nice.
Everybody here familiar with outlier provisions with the hospitals? Everybody understand what that's about? Okay. In North Jersey last year is a big hospital that got fined $18 million by the DOL. They had a software system in play that would tell them when a patient is approaching one of those outliers, and they would game that person to stay in the hospital or give them additional treatment so they could reach that dollar limit to provide them with less discounts and hereby collect more money, okay? That hospital, I think, John, was $1 billion over 4 or 5 years that they made on that, okay? The biggest thing is the balance billing, and it creates noise, but it's a different kind of noise than that you see today. Okay, your HR director or VP of finance, you're going to hear about PPO problems and questions and feel that all day long. For us, if you partner with an AMPS or somebody that has a legal backing and foundation that provides the education to your employees and they know what to do when you get that balance bill, okay, for me it's a no-brainer. Chris mentioned 18, 20%. Anywhere from 5 to 30% we see that's discount on the aggregate and specific costs. That's first year, okay? And then you're collecting experience on that data. Cypress is going to provide that, and you're going to bend the curve of claims dollars over a 3 to 5 year period. We have, and one more thing, we have one client, and this is in the state of New Jersey, $18 million spend. They saved $4 million the first year. Okay, they moved from Blue Cross into a reference-based reimbursement program. Okay, so I think everybody is compelled to learn more about the program and look at it as a viable alternative for your employees or your employers, because I think it's something that's always going to stay under the radar. No hospital in this country wants to go in front of a court or in front of a jury and explain why. You guys have all heard the $1,000 toothbrush or the $800 pill and other things. No hospital is going to show in a disclosure process what they're actually billing clients, because they're getting between $250 and $350 in Medicare. Okay, so this is always going to be a viable option. That's my opinion.
And speaking of John, he mentioned yesterday the $25 million claim. Aside from scaring the hell out of you guys, what are you doing now that sort of the top has been lifted off the pot and everything can kind of go as high as it wants to because employers out there have to cover it? How are you kind of preparing for that, and how are you dealing with it, and what are your expectations on that kind of thing?
Well, clearly a $25 million claim is an anomaly, but one of the things that we do, and I think probably some of the other, if not all, do, even if we get a PPO claim in that has been repriced and sent to us from the TPA, we did another $5 million of repricing ourselves, going back and disregarding what the PPO did, and renegotiated and got an additional $1 million of savings. So we will get in the negotiation business if we have to too.
Another thing too is, and this is another reason why you want to be in the TPA world, and particularly a TPA that manages claims like Cypress, because if you're using a network today, okay, BUCA network again, they're going to apply that discount, and that could be 65%, okay? But as a stop-loss carrier, we can do little in the way of helping you manage that claim. Okay, we don't have the ability to do that. In fact, in most cases, in particular, it's written in the plan document that says we can't even get involved in the case management. Okay, but when we're working, all the stop-loss carriers here, when we're working with Cypress, you have that. You get the trigger diagnosis, you get the pre-cert. You can start managing claims before they actually occur. When you actually have some say with the facility, again, another reason why you have to stay in the TPA world and work with TPAs like Cypress.
Anyone, am I missing questions out there? All right, Steve, one of the things I think we need to revisit, something that you indicated before, you talked about the plan document and the SPD, and everyone out here is obviously reliant on those SPDs. historically, there have been problems with the plan document as written and the stop-loss contract as required. How do you deal with those gaps in coverage, and how does an employer or a consultant identify those kinds of things?
Well, I would tell you that first and foremost, it's key that the plan document is reviewed by the stop-loss carrier prior to the stop-loss policy being issued, so that the stop-loss carrier has the opportunity to identify any discrepancies between the policy and the plan document, bring those to light ahead of time prior to the claim, and work with the TPA and the employer to figure out, okay, how are we going to close that gap in coverage? We've been working with Cypress for so long, we don't have many of those conversations anymore because we're very comfortable with the plan document that they provide, and we've reviewed them all, and there are few, if any, discrepancies in coverage. But there is the issue that I think John said it in his presentation yesterday. If you're an employer and you get a discount from billed charges from a network that still results in a overbilled reimbursement, or a reimbursement that is in excess of what anybody would consider to be reasonable and customary, it is really a violation of your fiduciary responsibility to pay that amount. So, we need the plan document to have some teeth in it relative to being able to establish a reasonable and customary amount. So as Chris indicated, that when we get that, the 5% of those facility claims that are outlier type claims where we've got a rogue provider that's just feels that the self-funded plan is a blank checkbook, that we have an ability to challenge that claim. We win some, we lose some, but we've got to be able to at least offer a challenge to those excessive bills.
One of the things at Optum that we like to toot our horn about is kind of what Tom was just asking about, is the difference between the plan document and the stop-loss contract, whereas the self-funded plan is really different than any other coverage you're dealing with. So you have something that the SPD is going to determine what's going to be paid, and then the stop-loss contract tells the employer group what's going to be reimbursed. They can be two different things. So when you look at our contract, we have 3 exclusions: war, fraud, and workers' comp. The workers' comp can be changed if you do have some, let's say, farmers that are on their own, but essentially that's our only 3 exclusions. So to answer your question, there really aren't concerns. So, but you can have quite a few exclusions in your stop-loss contract, and if the wording is not exactly the same, they're not the same.
Yeah. I do have a question about, because I think everyone here on this panel knows, and most of you probably know, that philosophically where we stand on stop-loss carriers is we think it's beneficial to renew with the incumbent carrier as long as possible, as long as the relationship that we and you have with the stop-loss carrier is good and working correctly. I guess my question is, with respect to renewals, let's see, I think there are maybe 2 lines of thought on this. One is with new business, the other is with renewals. But with respect to renewals, how important is sort of being the incumbent? And because much of you see that our trend line is low, our loss ratio, I can tell you, I mean, Pete alluded to this, but I can tell you that our entire block of business last year, our loss ratio with our stop-loss carriers across the board was 51%, which is, I'd be interested to see how that compares to everyone, but 51%. But when you're looking at renewing a case, especially if the case has maybe a potentially big claim, or has in the past year had a big claim where maybe you've lost money on that, how important is that incumbent relationship, and how much do you take that into account when it comes to underwriting and trying to get as competitive as you can from the premium and attachment point standpoint?
Well, Tom, I can tell you, I just went through renewal with some of your people, and there was a woman on the plan that we thought was very ill, and we had put a conditional laser on her, and the employer could not understand that, and it took us probably an additional 2 weeks. But if I didn't have the relationship I have with your staff, and we weren't the incumbent, it could have just got conditional laser left on, and the employer would have been upset. But with the extra work that your staff was able to do, we were able to find the notes from the doctor and get that removed.
I think, it's hard to write new business as a stop-loss carrier. So when you get a new client, it's imperative that you do whatever you can, especially a well-performing client, to renew them at all costs. And sometimes, like as Chris had mentioned, you're inevitably in a situation at renewal where you have an ongoing claim or something of that nature. But I think it's imperative as a stop-loss carrier that you provide your client with a number of different options, okay? And then continue dialogue with the TPA, Cypress, in that process. As Chris mentioned, there's always updated information coming up there, but as a stop-loss carrier, you can do different things. You can provide running limits, you can provide different contract basis for claims, you can provide aggregating specific options, conditional laser options. It's not just one renewal piece, one renewal option, and then take it or leave it. I think it's an ongoing, continued dialogue. But also, you look at the account over not how it's done in that particular year, but the performance of that group over time. In the stop-loss business, you're going to have one every 4 or 5 years. You're going to have that large claim, and we understand that, but might not be indicative of the performance of the group over a long period of time. So we typically see a large claim, and it's in our best interest not to overreact when we see that, because we know that we're going to be able to make up some of that money in the next year or 2 or even 3 years. So we want to try to hold on to that.
I think everybody up here, when you look at those cases, as Tom was asking about, that when you have claims, how we look at them, and everybody up here is going to weigh that experience, and it's either going to be fairly indicative of what we think is going to happen in the future, but everybody's going to have their own kind of understanding of what's going to happen in the future. And then I would say for even probably individual underwriters, with each of us might handle that renewal a little differently. Or it might even come down to the day, that if that underwriter had a case that they just got their hand slapped on a case that they went out aggressive on, they may not be as aggressive that day on a similar type of renewal. So it can certainly change the opinion of that underwriter of what they want to do going forward. So it just, so when you look at their experience, for us, it does, it's indicative, especially the larger the group. If you've ever taken any kind of stats class, larger the group, the higher likelihood that's going to happen again in the future. So a smaller group, they have a bad year. It may not, thought might be that they probably won't have that same thing going forward. 1,000 life group is probably going to be fairly more indicative of what they're going to have in the future. That's right, indicative. That's a big one.
Just one more comment, Tom, if I could. Ask when you're going through a laser renewal, ask your underwriter probabilities. I like to speak in probability terms. I mean, laser is not always a bad thing when you have a claimant at stage 4 cancer who, with given the option of increasing the rates for the groups per year or taking the laser is obviously a much better option. I always ask, as a salesperson, ask my underwriter, hey, potential laser here, what's the probability that laser will occur in the next 3 to 6 to 9 months? That'll help you guys make a better decision on what option to take. So.
I'm with you on that. Let me ask about, and because this is a sensitive issue between our sales staff and the brokers and consultants that are out there. Our goal, obviously, is to get the best price we possibly can. But is there a danger in focusing, and I don't really mean this for the employers to understand this, is there a danger in focusing on just getting the cheapest policy you possibly can?
Absolutely. In fact, not to be the old man in the group, but I've been doing this for 31 years. In the first part of my career,
the old man in the group.
I was in first part of my career, I was a TPA, and back in the 80s, the fixed cost we just never focused on because it's the claims that are basically 85 or 90% of the planned cost, and that's where you should be focusing your attention. I mean, fixed costs do matter, and you want to get a good price, but it shouldn't be the overriding concern.
Yeah, I mean, it boils down to what portion of your spend is on the stop loss, and it varies. Obviously, it's a little bit bigger portion on a smaller group, perhaps, but I think sometimes the forest gets lost for the trees because the focus is on the insurance buying process rather than on the entire claims management process. I know it can be probably a little intimidating to look at a proposal sheet with line after line after line of services and charges, but it does seem, at least it feels at our end, that the focus tends to land on that fixed cost premium line, secondarily on the aggregate cost line, and then the rest. And we get frustrated because we feel like we're treated as a commodity on occasion, but at the end of the day, we are largely a commodity. We're catastrophic protection for your financial risk to your plan. But there is devil in the details. Our policies do differ. Some are better than others. The details matter, and you get what you pay for.
Unless does anyone else have a comment on that?
I just have one quick, I mean, and having loyalty with your carrier, not moving for, for a few percentage points on the fixed costs, it does have merit where, now we have 2 or 3 years of experience with you. We're not just looking at the current year, we're looking at all 3 years, and, we could be a lot more flexible with you.
I would just want to comment on the "you get what you pay for" comment, because I think that is very, very true, and I kind of talked a little bit about it yesterday. But we lost a case. I know it's rare, but we lost a case that a broker took to another carrier, and it was by far the least costly option for them. And it's one of those kind of situations where you go, well, all right, if that's what you got to do, go ahead and use it. Like, we don't understand why. That this particular stop-loss quote was that much cheaper. But away they went. And turns out the reason that was so much less expensive, that was never disclosed to the client by the broker, is because there was a run-in limit of $25,000 for specific claims, not just an aggregate run-in limit, but a specific claim on a $25,000 basis, meaning that there are no claims over $25,000 was eligible for coverage in the new year. And it happened to him to the tune of about it was like $140,000, $150,000 claim or something. And then all of a sudden, all that was covered under the spec was $25,000 worth. So, that's the caveat emptor, I think, that we bring to the table. You need to know what the conditions are. You can always get cheaper, right? But that comes with a price.
Just also look at the time of reimbursement, right? You have a company that's 80 lives, and maybe they don't have the budgets of a Fortune 500 company. They want to be able to, if they have a stop loss claim, get their money back quickly and in a timely fashion. There are stop loss carriers out there that are 60 to 90 days on initial reimbursements. I mean, that's just not acceptable, right? So those carriers are probably less expensive. But if getting your reimbursement back to you is important to you, then that's why you buy stop loss.
Sure.
From a reputable company.
Excellent. Oh, Vic's got a question. What do you know?
Of course, Vic's got a question. I would just, as a general question to the stop loss carriers, if you have somebody that a case is presented to you that is probably not non-traditional now, since the industry trend is the cost containment, pre-certification, case management, and you have a case that says, I don't want any of this. What do you do when you underwrite that claim? I mean, how do you react to that? Or not claim, but underwrite that proposal?
I'm going to pass the mic on, but say we're not going to be very competitive.
I'm going to say stay fully insured. I mean, if they're not going to implement if I'm understanding this correctly, no pre-cert programs or case management, any of those programs, I mean, that's what self-funding is all about. I mean, do they really want to do this? I mean, to be honest with you, we can give you a quote. I'm sure we all could give you a quote, but it's not going to make sense. I mean, we need to implement all of those key cost containment programs.
I don't see it. I don't think any of us see that often, where you have those groups that are not willing to do anything. And typically, I see them when they're already self-funded, and our mentality is that, well, if they've never had it in the past, their claims history is going to be a result of them not doing anything. And we'll rate it just basically like any other group to say, well, this is what their history is, and therefore it'll be based on that claims experience. We prefer if they did it, but if they don't, that's fine.
Vic, are you willing to share with everyone what your plan design is for your plan, or do you not want to do that? All right, wait, let Vic, just to follow up, just give Vic the microphone real quick just to follow up. Tell everyone what your plan looks like.
Our scheduled benefit is very simple. It's deductible of $200 per individual, $400 max per family, and 100% thereafter. And our employees don't pay for it.
Do you have a PPO?
We do have PPOs, and then but we also have the flexibility of allowing our employees to go anywhere they wish with or without a referral.
Do you have pre-cert requirements and a utilization management requirement?
None at all.
Who's your carrier?
Optum.
How's your experience?
You know what? I knew that.
Gotcha. How's your experience been over time?
Our experience has been wonderful. We've had, well, I have to say this also as an endorsement for AIG. We do have the organ transplant policy, and unfortunately we had to use it once, but it also saved a rate.
And how many employees do you have?
We have total on the plan, we have probably approximately 135, about 150 employees.
Okay, and are they generally centrally located, or are they spread out?
We're located in 3 states. The majority of them are in Wisconsin. We have an office in Illinois, an office in Indiana.
Okay, and I would say it's safe to assume that you have a pretty good employee education program, and that I would hope and expect anyway, that you're encouraging your employees to be smart in their healthcare decisions.
Well, that's the goal, but some people listen better than others.
Right. Well, absolutely. But and so I think what your underwriter told you is absolutely correct. That your success has been borne out in your experience, and they can certainly rate it based on the data that they have. So I look forward to seeing that at renewal.
Nice. Okay, we got time for one last question.
Yeah, I'd like to move into a little bit health and wellness and biometric screenings. There's a lot of employers that have very robust health and wellness plans. They've been in place for 12, 15, maybe 20 years.
There's other employers that have done little or nothing. And from a broker standpoint, it seems that when we're talking about renewing a case or
Prospective new business, we don't get any questions from your end about the employer's wellness programs, lack of, or involvement. We're talking about reference-based pricing, so I'd be interested in your thoughts in terms of what goes on in your back room historically as to why you haven't moved into that area, and if you see in the future more questions coming out from your end regarding those programs.
Well, if there was a program with an employer, we would hope that we would be notified of that when the RFP came to us to quote. And I would think that over time, especially the example you gave with 12 years, that the benefits of that program would show up in the claims experience. And so it would be below normal, I would guess, if it's working.
We, East Coast Underwriters, we have a profit sharing arrangement, easy funding, or I'm sorry, easy profit, and we do look at wellness programs. I'm not a wellness expert, but we can give up to a 3 to 7% discount based on how aggressive the program is. I know there's outcome-based programs and other programs, but we are giving a front-end discount on that, based on how strong the program is.
I think obviously the benefit of being self-funded or fully insured, and you heard Andrew this morning talk about how fully insured is bad and self-funding good, is data and the access to it. And we've all heard and seen wellness programs have little effect sometimes on the plan itself. But when you can get the biometric screening and when you can get the health risk assessment and you understand that you have 10 people in your group that are diabetic, okay, and those 10 people working 80% of the claims for your group, and you can implement a program with Cypress's help to really drill down on those claimants, that's where you really see the effect. And as Chris mentioned, in the experience rating, it'll come out in your experience, okay? Again, we're in a captive business with Pareto. We see loss ratios that are outperforming the market consistently because that is a requirement. Not so much the broad wellness perspective, that's always good, but the actual, the health risk assessment, biometric screening, retrieval of data, and then implementing a program after the fact.
For us at Optum, there is no button to push or anything like that if there's a certain wellness program. So it's not as if they're doing this, or this, okay, minus X percent. But what we've developed with Cypress is something that goes hand in hand with some of the cost containment things that they do, as well as wellness, is that we have a refund product it's built into our standard quote. So when they're doing those types of things to not have those claims, and they have a good claims year, they can get back up to a 15% refund of their specific premium. So that might be something that they'll reward them when they have those good years and they're doing the right things with that, as well as what Cypress is doing.
All right, we're over time a little bit, but just knowing all of you as I do, I want to go right down the line to finish this whole thing. First album, first concert. Well, Pete, we already knew about.
Wow, all right, first record, 45, 1971, I was 8 years old, Temptations, Ball of Confusion. First concert, after an Indiana Pacers game, it was the Staple Singers, and by the sixth song, the weed was so heavy in the air that the father of the kid that I went with dragged us out of there, so my first real concert was Christopher Cross. That's embarrassing, but it's what it took to get a date with this girl in high school, so I went. And my favorite band, probably only Tom and Steve know, and that's Little Feat.
Favorite band, the Beatles. The first concert was the Police, Zenyatta Badata, in whatever year that was. And as with Kurt, I don't think it was an album, I think it was a 45, and it might have been, if you think you're embarrassed, it was the theme song to Star Wars.
My first album was Led Zeppelin, so with Dazed and Confused on it. My first concert was 1974. It was Spooky Tooth with Gary Wright. It was Humble Pie with Peter Frampton, and Ronnie Montrose with Sammy Hagar.
My first album was Led Zeppelin, Physical Graffiti, and my first concert was Charlie Daniels and the Allman Brothers in 1980.
Really? You're asking me this
and
question?
watch what Mike Hirsch's answer.
Yeah, well, I'll tell you what. I was hoping you weren't going to ask this, but no concerts for me. I could tell you 2 songs. I don't even know who sings the one. I Love Rock and Roll was the one that I listened to a lot, and Van Halen, Jump. Those 2 songs are still on my phone when I work out. Those are the 2 I listen to. Other than that,
that's a short
I'm pretty
workout.
dry.
Yeah, yeah. Hershey only works out for like 4 minutes. It's amazing how much shape he is. All right, well, thank you, everybody on this Stop Loss. I appreciate it.